So when in 2007, when I was considering kind of how to spend the next decade of my career, I kind of felt like I wanted to pick an asset class, a strategy that would be attractive in the current market environment at the time. So in 2007, not that we knew exactly how bad things would get, but you would read reports about aggressive loan underwriting or the proliferation of credit or every company and every individual able to borrow at zero interest rates to be able to invest. So the economy at that time was getting very levered to consumption and levered to investing, and the economy was heating up very, very, very fast. Well, it turns out obviously that the market corrected, and we know why, because of a lot of the banking activity or the aggressive lending that a lot of banks did to encourage spending and investing. But it felt like to me at the time that investing my career, certainly over the next 10 years from 2007 to 2017, if I'm going to be in real estate better have a good run. Most people make money in real estate when things go up. So if things go down in real estate like they ended up doing for 08, 09, 10, 11, it was a really hard place to be. Not that I saw the future, but I just felt like that was a challenging headwind to invest my career and time in real estate. So instead, I found an organization that invested capital not on a long and levered basis, but on a hedged basis. So hedged.
If you like this video, please subscribe to my channel, like the video, and share it with your friends. It will really help me grow this channel. 你喜欢这个影片吗？请你订阅我的频道，帮我点赞，也分享给你的朋友。
So hedge funds are a very attractive asset class that many institutional investors use to diversify their portfolios because they are not betting necessarily on directions of the market. They're trying to find relative value within securities or within various markets. So a good basic example of a hedge fund would be, I want to go long Coke and short Pepsi, right? I'm not betting on one stock or both stocks going up or down. I'm saying I think Coke as an organization, as a company, will outperform Pepsi for various reasons. Maybe the markets that they trade in, or their pricing, or their distribution channels, or some consumption taste of a market they're going into. So whether the market goes up or goes down, I don't care very much. I care a lot about how Coke does relative to Pepsi. And if Coke goes up and Pepsi goes up, but as long as Coke goes up more than Pepsi does, I make money. And let's say the market in 2007 and 2008, as we know, had a massive correction, the S&P. Both of those stocks went down, but if Coke outperformed Pepsi and lost less money than Pepsi, well then I made money. And so that's what hedge funds do in a very simple way. And they do that with stocks, they do that with interest rates, they do that with credits, they do that with public or private companies, they do that with currencies, they do that with commodities. So hedge strategies are all trying to find relative value comparisons between those things. I might want to go long the US market and short the Japanese market. I want to go long the US dollar and short the Japanese yen. So in my job as a hedge fund allocator, we were trying to find strategies that would be attractive in various markets. And so as a career bet for me, it felt like a little bit of a safer place to be. I can make money if the market goes down, I can make money if the market goes up, and our clients can be happy either way. And that's why people are attracted to hedge funds so much. So that's what PAMCO focused on. We are a reasonably large private company. We managed about $10 billion, mostly from institutions. So our big clients were California State Employee Retirement System, New York State, sovereign wealth funds, corporations, IBM, Eli Lilly. So those were our big clients. So those companies, those institutions gave us money to invest in hedge funds, to invest in hedge fund strategies. And I did that for 15 years. It was a great run.
Campo, did you have a specific strategy on certain industries, or did you also have that, but also develop new strategies for your clients?
So I was part of our group that decided how to allocate the strategies within our portfolio. So I was effectively like a chief investment officer. So we would decide how much we want in equity strategies, how much we want in credit strategies, how much we want in equity market neutral strategies, how much we want in convertible bond arbitrage, how much we want in global macro. So my job and my team's job was to decide all of those different strategy allocations. So we would have 20% in one strategy, 40% in another strategy. So I was a generalist with respect to those strategies and a relative value comparison between all of those different strategies. And that's basically what I did for my job there.